Ever wondered how money makes the world go around? It's a fascinating question, and the answer lies in the intriguing world of finance. It's a realm that's more than just dollars and cents, stocks and bonds. It's a vast, complex system that forms the backbone of our economy, our society, and even our personal lives. Every time you shell out for groceries, save for that dream vacation, or even decide to start your own business, you're stepping into the world of finance. It's an invisible force that shapes the way businesses operate, how governments plan their budgets, and how individuals manage their personal wealth. In essence, finance is the art of money management, and it's pivotal in making the world function smoothly. It's a discipline that affects all of us, regardless of our backgrounds or professions. So sit tight as we embark on this journey to demystify the essential concepts of finance. What if you were told that money, in essence, is nothing more than a tool for exchange? It might sound strange, but that's exactly what it is. Money is a social construct we've all agreed to use to make trading easier. Let's break it down. First, money serves as a medium of exchange. It allows you to swap your hard-earned cash for goods and services. It's a lot simpler than bartering chickens for shoes, isn't it? Second, money is a store of value. It enables you to save today and spend tomorrow, preserving your purchasing power over time. Third, money is a unit of account. It provides a standard measure to compare the value of different goods and services, making trade more efficient. The flow of money, from wages to purchases to investments, is what keeps the economy running. It's like the bloodstream of the economy, carrying the life-giving oxygen to every part. Money, then, isn't just about buying things. It's a key player in the economic game. Ever planted a seed and watched it grow into a tree? That's what investment is all about. Imagine the world of finance as a vast garden, and each of us gardeners, we're given seeds, our income, savings and resources, and it's up to us how we choose to plant them. Those seeds, my friends, are your investments. Investing in its simplest form is the act of allocating resources with the expectation of generating an income or profit. It's the decision to forego immediate gratification and put your money to work, so it grows over time. It's like planting a seed and nurturing it till it becomes a tree that bears fruit. Now, investments aren't one size fits all. They come in various forms, each with its own potential for growth and risk. Let's talk about a few of them. First, we have stocks. When you buy a company's stock, you're buying a piece of that company, becoming part owner. Your return on investment depends on the company's performance. If the company does well, the value of your stock goes up. But remember, if the company doesn't do well, the value of your stock can go down. Next, we have bonds. Buying bonds is like lending money to a company or government. In return, they promise to pay you interest at regular intervals, and return the principal amount at maturity. Bonds are generally considered safer than stocks, but offer lower potential returns. Then there's real estate. Buying a property to rent it out or sell it later at a higher price can also be a profitable venture. But it requires significant upfront capital and isn't as liquid as stocks or bonds. Regardless of the type, the key to successful investing is diversification, spreading your seeds across different types of investments. This way, you're not putting all your eggs in one basket, reducing risk and increasing potential for returns. Investments, therefore, are the seeds that can grow your wealth tree. So, think carefully, garden wisely, and watch your wealth grow. Would you walk a tightrope without a safety net? Probably not. And that's where understanding risk and return comes in. Now let's try to simplify these two concepts. In the world of finance, risk is the potential for uncontrolled loss of something of value. On the flip side, return is the gain or loss made on an investment. Picture it this way. You're at a buffet. There's a wide array of dishes from the safe and familiar to the exotic and unknown. The safe dishes, those are your low-risk investments. You know what you're getting and you're pretty sure you'll like it. But the potential for a surprise, that's not so high. Now, those exotic dishes, they represent your high-risk investments. You might end up discovering your new favorite food, or you could find yourself regretting your adventurous spirit. That's the risk you take. But the potential return, the reward, is often much higher. And here's the key. In finance, just like in our buffet analogy, there's a direct relationship between risk and return. Generally speaking, the higher the risk, the higher the potential return. And vice versa. The lower the risk, the lower the potential return. This brings us to the concept of diversification. Imagine going back to that buffet, but this time you're going to smartly spread your risk. You take a bit of the safe dishes, a bit of the adventurous ones, and maybe even try something in the middle. Now, you've balanced your plate, or in financial terms, you've diversified your portfolio. Diversification is a risk management strategy that mixes a wide variety of investments within a portfolio. The rationale behind this technique contends that a portfolio constructed of different kinds of investments will, on average, yield higher returns and pose a lower risk than any individual investment found within the portfolio. So, striking the right balance between risk and return can make your financial tightrope walk a success. Did you know that money also has a price tag? It's called the interest rate. Think of it this way. When you borrow money, you're not just getting a free pass, you're renting it, and like any rental, there's a fee involved. That fee is the interest rate. It's the cost of borrowing money, and it's how lenders make their profit. On the flip side, when you deposit money in a bank or invest it, you're essentially lending your money to the bank or the company, and they pay you an interest rate for the use of your money. So in this case, the interest rate is the return you earn on your money. Interest rates play a crucial role in the economy. They're like the financial temperature gauge. When the economy is running hot with high inflation, central banks raise interest rates to cool things down. Higher interest rates make borrowing more expensive, which tends to slow spending and investment. Conversely, when the economy is sluggish, central banks lower interest rates to stimulate growth. Lower rates make borrowing cheaper, encouraging spending and investment. So, you see, interest rates are a key tool for managing the economy. Now let's bring it home. How do interest rates impact your personal and business finances? Well, if you're a borrower, high interest rates mean your loans cost more. If you're a saver or investor, you earn more. For businesses, high interest rates can make it expensive to finance operations or expansion. But they can also boost earnings for businesses in the financial sector, like banks, who earn more from lending. So, whether you're borrowing for a car, saving for retirement, or running a business, interest rates matter. They affect the cost of your loans, the return on your savings, and the profitability of businesses. In essence, interest rates are a bit like the weather. They can be sunny and inviting, encouraging growth and prosperity. Or they can be stormy and challenging, making financial progress more difficult. Interest rates, then, are the price you pay or earn for the use of money. So, keep an eye on them. They're more important than you might think. Imagine a thief that slowly and silently steals your money's value. Meet inflation. Inflation, as mysterious as it sounds, is simply the rate at which the general level of prices for goods and services is rising. It's an economic phenomenon that impacts us all, but not always in ways that we can easily see. To understand inflation, think about a candy bar. Let's say it costs $1 today. But over time, due to inflation, that same candy bar might cost $1.25 next year. That's inflation at work, eroding the purchasing power of your money. Inflation is like a thief that operates in the shadows, silently stealing away the value of your money. It's not that your money is physically disappearing. No, it's more subtle than that. Your money is still there, in your wallet or your bank account, but what you can actually buy with it is gradually diminishing. While a little inflation is considered normal, and even healthy for an economy, too much can be damaging. When prices rise too quickly, your money isn't just losing value slowly, it's plummeting. That's when you might start to feel like you're running on a treadmill, working harder and harder just to stay in the same place financially. That's where central banks come into the picture. Their job is to keep inflation in check, to prevent it from spiraling out of control. They do this by adjusting interest rates and using other monetary policy tools. When they see inflation heating up, they might raise interest rates to cool things down. Conversely, if inflation is too low, they might lower interest rates to stimulate spending and push prices up a bit. Inflation is a complex concept, but it's an important one to understand because it affects every aspect of our financial lives. It influences everything from the prices we pay at the grocery store, to the interest rates on our mortgages, to the value of our retirement savings. So, inflation is the silent thief that can rob your money of its value, but with knowledge and planning, you can keep it at bay. So, we've journeyed through the world of finance, uncovering its essential concepts. We've seen how money serves as the lifeblood of the economy, enabling transactions and fostering growth. We've discovered the power of investment, the seeds from which wealth can sprout. We've understood the importance of balancing risk and return, a delicate act that can make or break financial success. We've delved into the significance of interest rates, the price we pay for the use of money. And we've discussed the impact of inflation, the silent thief that can erode the value of our savings over time. Each of these concepts plays a vital role in our financial lives, whether we're conscious of it or not. And so, we wrap up our journey into the world of finance. But remember, understanding finance isn't just for the experts. It's a tool we can all use to make informed decisions and secure our financial future.